Good afternoon. Today is the 23rd of July, 2014. Present time is 12:40 p.m. Wednesday, again, July 23rd. This is timeanddate.com, in which we have no affiliation. In a moment, we're going to give an update of the options trades that we've put on using Isometry. For those of you that have just come to the site for the first time, we utilize here a methodology which combines two disciplines. One is uh, combining the three pieces of information that are always available on every chart, and that is price, volume, as well as what we call alpha. Price simply means that there are certain price levels that professional money is going to take interest in. Volume, the volume that is contained in each of these bars, and what we call alpha. Alpha is a subtriangulation of three components, and that is the high, the low, and the close of each bar. So if we were to look at this bar here, it would be the high, the low, and the close. This bar here, the high, the low, and the close. Or let's say this bar here, the high, the low, and the close. What we mean by alpha is that we've combined these bars into a particular our research has discovered a particular reoccurring sequence which identifies a high probability of a price reversal. At that point in time, instead of just buying or selling the underlying, which can only be the futures or stock itself, we then in turn take this and we move into the options market. Instead of buying options, um, we are selling options. Instead of selling naked options, where we have unlimited risk with a finite return, we hedge that, lowering our risk, establishing our probability, establishing our profit, and we initiate what's known as a credit spread. Now, what we want to talk about here to the right is basically this is why numerically we've done the research, and all the numbers that we've come up with show that essentially we are numerically superior to futures trading. What do we mean by that? Just look at the numbers. Let's say, for example, we decided to go short here right now, and that's what this orange line is. Let's say right now we decided to go short. And as a trader, you are only going to short two things: the stock, you're going to leverage yourself, they're going to typically give you 2-to-1 leverage, depending on your credit, or you're going to trade futures. That's your play. So let's look at this universe here, and we're going to compare the three possible moves: up, sideways, or down. As a futures trader, if it goes, um, actually this is reversed. This should be red. If it goes up, because we're going short, if it goes up, you are a loser because you only profit if price goes down. If it goes sideways, you make nor lose. You're just wasting time. So we color it gray. And if it goes down, then you make money. Out of the three possible moves in these three possibilities, you are 1 for 3, or 33%. Out of all the moves, you only can benefit of 33% of those. As an options writer, if price were to go up, and this is a vertical incline, okay, we would lose money. And there is a caveat there. Our losing money is not based off of this entry price, because we typically chose a price somewhere far out of the money. So we do not immediately lose money, but we're going to give this as a loss anyway. Okay? If it goes sideways, we make money due to time decay because options are a wasting asset. So every second of the clock, it's like an ice cube melting in the sun in terms of the value of that option because we want it to expire or to lose value. And obviously, if it goes down, we are also making money right away. So in this possibility, three moves, we make money 2 out of 3 times, or 66%. Numerically, we've got futures traders beat in this environment. If we devised it into this these possible moves, sharp move upwards, not a vertical climb, but a sharp move upwards, gradual incline, sideways, gradual decline, sharper decline. In this arena, okay, if price went sharply up, you would lose money. If price went gradually up, you would lose money. If price went sideways, you're wasting your time, you're winning nor losing. Gradual incline, you make money. Sharper, gradual decline, you make money. Sharper decline, you make money. In this arena, out of 5 possible moves, a futures trader only benefits 2 out of 5 possibilities, or 40%. In options, gradual incline because we are out of the money and this is a wasting asset. We don't mind this. In fact, we can make money in this environment. Here, obviously, time decay, we make money, and all of these, obviously, we make money. In this arena, futures trader 2 out of 5, 40%. Options writer, we're at 4 out of 5, or 80%. If we devise it up into these possible moves, vertical move, sharp increase, gradual increase, sideways, gradual decrease, sharp decrease, vertical decrease. Futures trader, 3 out of 7, they lose, 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 sideways, so you can't claim that. Gradual, they only make money 3 out of the possible 4, or 43%. In options, sharp increase, provided it goes past or out of the money trade, lose money. So we give them that. Sharp or sharper increase, provided it goes past our price, which is somewhere out there, somewhere out here, we lose money. Gradual increase, because of time decay, we can make money with that. Sideways movement and all of this below that, of course, that's our realm. Out of this possibility, once again, 5 out of 7, 1, 2, 3, 4, 5 out of possible 7, 71% to 43%. So in all three scenarios, we've got you beat if you're a futures trader. That's the numerical superiority. And those numbers bear out because this is, there's a study that was done and they said that 80% or 82% of all options written expire worthless. But what they don't talk about is how many options end up being worth less. 2 words, worth less. Meaning we don't need it to expire to 0, but how much do they actually lose? Do they lose half their value? Do they lose 70% of their value? So not only do they become worthless, but they also become worth less. So if 82% of them that they say end up becoming 0, how many of them actually decrease by 30%, 40%, 50%? You see? Okay, this is a review of update of some of the positions here. Let's get a timestamp here. And the present time is 12:52. Okay. The Amazon trade, we're open, we're up $233. We have about $1,600 in premium on this. BAC is essentially worth 0. So we've established if we wanted to sell this right now, we could create an order and they're pricing this credit spread at 0. Okay, so we got 100% of that. Over on the right is the margin required. So if you were to put up 2500, you were looking at 300 and it required 2500. So this was a 10% return on in less than a week. With our SPX, we sold some credit spreads, 25,000 required. I think we're at about 5,500 or something worth of premium, but right now we're above 10%. We're about 4,000. We closed out the OEX, by the way, and picked up 5,500 of the 6,000. USO, as what we've discovered, we're going to be going to USO. We're not going to be trading the crude oil futures anymore. We're going to be trading the ETF or the USO, which is essentially the equivalent. It tracks the same. The advantage is that we're able to write the weekly options that have the faster time decay. We're going to do the same with gold, and that's the GLD. Okay, so you're going to see this being phased out. All right. We want the weekly options because it's a faster time decay. I mean, it's just a faster slope. So USO, we opened that up. What day did we do that? If we view the trade here, we did that on the 21st. Yeah, so that's when we did that this week. So we're up 150, and I think we've only got about 400 worth of premium on that. So, but now let's look at it this way. If you're able to do 5%, just 5% on your money per week, or let's say 5 to 7.5%, you would have 7 times 5. You'd be doing 30% per month. No one would believe you. They wouldn't believe you. They would say you're lying, and that's why we show you this. We show you this. See it for yourself. So you see what's possible out there, so that you understand that you're not doing us a favor by taking our course. Not at all. As a matter of fact, let's be clear. You are lucky to be seeing this right now. You're lucky to be seeing this. So this environment is doable because look at all the things we have on our side. We've just shown you in terms of the possible moves. We've got futures traders numerically beat. In terms of time decay, I mean, it doesn't matter. Here's a stock. This is an energy. This is metal. Now, let's talk about this crude oil trade here. We're down 2,500. You want to know why? Because we sold a September option. We've got 23 days remaining, so this is gonna take time. We should have done the weekly option. So if this gets to zero or 500 profit and we see another option that we could write for the weeklies, we'll just roll out of this into the weeklies. Because if we would have sold this, if we would have done this with the weekly options, we would have made money. We'd be out of it right now. But that's okay. All right. So let's just give that time. ES, we're at 312. This is already bouncing somewhere around 5%. This was about 375 right now. Gold, we're at 2,000 right now. This was 31,000. Again, as I said before, we're going to be switching to the GLD. So right now, if we wanted to close this out, we'd be at about 4,500, which is about 5% of what capital required for the week. These are all weekly. Well, these are not weekly options, which we mentioned before. But even considering that, that's what we would have. But we're not closing that out because it's still fine. Okay, so there you go, guys. That's going to do it. Hope you learned something. Take care.